Welcome to Money Talk with Aaron Ricketts, presented by Ricketts & Associates, 3245 North Adrian Highway, Suite F. The opinions voiced on Money Talk are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial, or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA SIPC. Welcome, Aaron, back. Not in the studios. He's on the phone. How's it going, Aaron?
Good. I'm on remote.
Right.
Yeah, remote, whatever you guys call that.
Yeah, cool. That works. So the markets continue to kind of amaze me, but you just got to take it one day at a time, right?
That's right. I agree with you. I always look at, I look at it. I tell my clients, I tell people when they ask me about the market in general and about investing, I say, the health of the stock market is, based on the health of the economy. They usually go hand in hand, and it's all about company earnings, right? Company earnings are going to do well. If they do well, the market often does well. I mean, it's just they go hand in hand. So, of course, we had a shock to the system, right? A month, about 6 weeks now of, this down market. So during that period of time, we've had, I say, minor adjustments. We had that major downfall, and then it came back, and it's been kind of sitting at a level for the last, 2 going on 3 weeks, and that really hasn't changed. So, and I want to reiterate, when I talk about the stock market, I am talking about the Standard & Poor's 500, which is the 500 large companies that are in the United States. And one thing that might be an explanation for this and how and why markets are doing what they're doing is the top 10 companies in the S&P 500 make up about between 25 and 30% of the value of the S&P 500. So you remember, as goes GM, so goes the country, something like that. I mean, General Motors kind of, because they're such a large part of the economy, however they were doing or faring, so was the economy or the American stock market. So that's how I see these companies, this group of companies. Well, that group of companies that makes up such a high number or high value of the market is going to keep, call it artificially, or bring up all those companies, to their level. 7 out of 8 of the top 10, 7 out of the top 8 companies on the S&P 500 are at or above, or near or above their all-time highs. And they include Microsoft, Apple, Amazon, Google, Facebook, Johnson & Johnson, Walmart. But just as I have said some of those names, it kind of makes sense, doesn't it? That they would be at all-time highs because we got money flowing into those companies. We know that technology, and I shouldn't say we know, I watch this stuff every day. Technology are experienced the biggest cash inflows that they've had because so many people are doing business or doing work and doing all those things that they might not do or use the technology before this happened, are using it now. And there's money just flowing in there, so their bottom look good. Their profits are going to look good. So it makes sense. But with that stuff said, this might be what's, just kind of holding up that S&P 500, that market. Because the Dow Jones is down about 50% more than what the S&P 500 is down. Because that 500 that I talked about, I don't know what the number is exactly, but at least 30 to 40% of them are above their year-to-date highs. So again, all those companies are holding up the entire index itself. Instead of being down, 30, 40%, we're only down 11% as of this last week. So we hit our bottom March 23rd. We were down 30% for the year. We were down even more than that from the peak, near 37, 38% of the peak of the market. But just look at year to date, we're down that much. So that's where we stand and where we are. And even though we might see, another bottom, or we might decline some before this all gets resolved over the next 6 months, a year, however long it's going to take, I think the focus should be, especially if you're looking at your retirement account, is to focus on that long-term plan that you have. Everybody's plan is a little different. A 30-year-old plan, 30-year-old that's still investing and contributing to their 401k or retirement plan has a different time horizon and a different way of investing than a 70 or 80-year-old that maybe is taking income and needs a lot of income to sustain their lifestyle. And they have different kinds of needs and what they need, so what they might need. So they're more conservative and more aggressive. We all know that. But the whole idea about diversification and staying invested is not just casual words to just say, yeah, I've heard that before, because we get worried, right? People are worried or concerned that, could it go all away? Well, I'm going to sit here and say, I don't think that's ever going to happen. And, we've gone through some rough times in the last 20 years. I know I've been in the business that long. And, 2000, 2002 was rough. And, of course, 2008 and 9 and, 1 or 2 or 3 years after that, while we were trying to build our economy back up, those were rough times. And then here we are again. So we're just in those cycles. However we get there might be different, but we're in that cycle where we're going to have this pretty good, harsh recession. It's going to be hopefully short-lived, and maybe we recover, like I said, in 6 months to a year. Things are improving, and we look back, and it's a different world. Of course, we got science versus our economy, and how we're going to blend those together and make it safe and make it comfortable, for people to go out there physically and mentally, make sure that they can do their work and do those. We all want to work. We want to get out there and do something. So let's talk about why you should stay in the market.
Well, I was going to ask you a question, Aaron.
Sure.
Sure, there's a number of companies that have come out with sharp declines in their earnings, but do you think there's a fairly substantial number of the populace that's sitting there saying, well, we know why they've gotten poor earnings, but the reason their earnings have declined do not have anything to do with the intrinsic health of the company?
Right. Absolutely. And so they're just waiting it out, right?
Right.
Stay invested, waiting it out. Most of us aren't individual investors, meaning we don't go and pick individual securities or stocks. We own mutual funds. We own it. We hire a financial advisor and let them do the work. Most of us don't do that stuff. We are already diversified because of that. But we're not going out and looking at, specific industries. Like I have done that a little bit recently to find, what's been beat up, right, and see where that opportunity might be. But there are some areas that aren't down. I said that 11% that we're down in the market. There are many, I should say many, there are some categories, financial company categories that are in that S&P 500 that have taken a beating, and they're still not back up, 50%. They're off their year-to-date highs. Banks are one. Banks took a really good beating, down 60, 70%, including your regional banks. And they've really only come back maybe 20, 30%. So they're down still 40, 50%. Of course, cruise lines, they have virtually no income coming in, right? So there's an industry, you would think that their stock price would be near zero. But, they're still down about, 60, 50, 60, 70%. So there's still something there. Casinos, there's nobody gambling. And I say that, there's nobody gambling maybe in the United States, at least in the casino, maybe some online stuff. But in Asia, there's they're opening back up and have been, so their casinos are getting some revenue. Oil companies, right? When oil price goes from $40 a barrel to, less than 10, 5, we had strange days there, right? Last week or two, where the price was negative, but it's back up to $20, $25 a barrel, and we're probably going to see $40 a barrel oil. But those companies that are in that business are beaten down, and they're still down there. And then your financial services, in addition to banks, such as my company, LPL Financial, and Raymond James, and some of the Morgan Stanley, the big companies out there, they're down 30, 40, 50%, or they were at one time, and they still got some ways to come back. So there's a lot of opportunity out there, but you just got to be cautious and careful. And I always like to let somebody who has a bigger and better degree than I have to do that investing. So I hire those people to do that. Of course, I give you my advice here and there, or my opinion, but that's where I stand on that.
Well, do you think there's any merit to perhaps, depending on the person, taking some losses for taxes and reallocating, not getting out of the market, but reallocating their portfolio?
Yeah, certainly. Some of the categories, they have been beaten down, and I gave you the company categories, but the mutual fund categories are the small cap. Small cap growth and small cap value has really been hit hard. So, if you're looking to add a little bit more risk to your portfolio, that might be an area where you could do that. If you're younger and you can tolerate more risk, that's where you might want to look. But I certainly don't think you should, shift everything one way or the other. It certainly is always a good time to rebalance during this time, because what you might find is that, if you had 20% in small cap or 30% in small cap, you might find you only have, 15 to 20% because the large cap has done so well, right? It's not down as much. So you might have to, rebalance and diversify, and that alone might give you a little bit more risk, or the risk that you might need. So that's a good question. I did want to talk briefly about the staying invested, and just here's some numbers over the last 94 years. So that takes us back to 1926. 94 years. So that's kind of where we have really good market information through that period of time. Of that 94 years, 69 years were positive years. 25 years were negative years. Of those negative years, less than 6 of those years, of the 25 years, less than 6 were more than negative 12%. Only 6 of them. The rest of them were all negative 12 to 0. Okay? Those 69 years that were positive, 14 of those years were 0 to 8% returns. There were 6 8 to 12% returns. There was 14 12 to 20% returns, and there was 35 20% returns of those 69 years. Isn't that amazing? Over half. It's over 20%. So here we are, most likely this year, in some fashion, we're in that negative period, right? But we know that probably in the next 1, 2, or 3 years, we're going to have that bounce back. And if you're not invested, or you don't keep as much money invested as you should, you're going to miss out on that. And here's the growth of $1 million is what they have listed here. I wish it was more reasonable, but it'd be nice if we all had $1 million to have invested in 1999. So that was, 20 years ago, right? 21 years ago. If you had just stayed in the market and did nothing, today, even after this market decline, you'd have $3.1 million in that 21 years. Okay? You'd have a lot more, 6 weeks ago. But here we are. This is how this stuff works. $3.1 million. If you missed the best 10 trading days out of all that time, 20 plus years, all that time, just 10 days, you'd only have 1.4 million. If you missed the top 25 days during that entire time, that's just, in essence, just one day a year, you'd only have 700,000. So I tell my clients, I tell anybody, you have to stay invested. We don't know when this is going to drop. We don't know when this is going to go up. So what we do is plan for the future, which is looking at the market historically and see that, year to year to year, over every 5 years, 10 years, 20 years, and you're going to be invested in this market 30, 40, 50 years, 60 years. Historically, that market is going to give you a positive return and is going to give you a return well over 5% annually as an annualized basis over a long period of time. So you have to stay invested.
Well, Aaron, I'm sure there's people out there that have some important questions on their minds. And how can they talk that over?
They just give me a call, 265-3540.
All right, Aaron. Well, one of these days we'll see eye to eye.
I think so. Coming soon.
Okay. Take
All right.
care. That's Money Talk with Aaron Ricketts, presented by Ricketts Associates, 3245 North Adrian Highway, Suite F. The opinions voiced on Money Talk are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA SIPC. Join us once again next week for Money Talk here on 103.9 WLEN.